Hey guys, Akil here. Welcome back to the Trading Coach Podcast, another video edition. So head over to Spotify or YouTube to check out the video version of this. Of course, the audio version works fine as well. Today, we're going to talk about two words that I hope you never see in trading. And those two words are margin call. It's actually, we're going to talk about a little bit more than that. We're going to talk about risk management and portfolio developmentation, but margin call is a big part of that. And I want to explain that to you guys as well. Now, before we hop in, real quick, online trading workshop, May 29th, coming up soon. Seats are limited. I haven't checked today, but last I checked, there was only like 100 or so left. So if you're going to sign up for it, make sure you do not waste any time. There is a hard cap on the amount of people that we can let in, 500. So make sure you sign up. Go to tier1trading.com if you're on your desktop, or search the link in the description box below. And if you can't find any of that, just hit me up on socials, give me a DM, and I can give you the link. But trust me when I say you don't want to wait until the last minute, because you're going to miss it, you're going to be sad, and then you're going to email me asking if you can get in. I'm going to say no because of that hard cap. So just do it. Now, today's episode comes from a question I got from one of our Tier 1 members. It was a follow-up in a long line of questions, but let me read that to you and you'll see how it sparked a conversation. So, trader says, Akil, I got two questions for you. First is, I heard you say on a podcast, I'm doing a cheesy smile for you listening on audio only, that if you don't place that many trades on the higher time frames, then you can raise your risk per trade slightly. I trade the daily charts and I put on maybe 2 or 3 trades per week if I see my signals, but I only put about 0.25 to 0.50% risk on all of the trades or on the trades. So what you're saying is I could put 1% risk per trade and still be okay with the drawdowns since I don't put many trades on in the first place. That was part number 1 of the question. We scrolled to see part number 2. Part number 2 said, secondly, since I trade the daily, when do you decide that a trade is not going to work? Actually, we're not going to talk about that one. We can save that for another time. I want to talk about the first one. So, before we can get into this, I want to explain the two words that I hope you never see in your trading account, and that is going to be margin call. And I guess before we get into margin call, let's explain for you guys that are new, what is margin? So, in the most briefest, dumbest way possible, because that's become the theme of the Trading Coach Podcast, Akil Stokes, brief and dumb. Yeah. That's a brand, isn't it? It's my brand. I'll take it, right? Yeah, funny story, right? All my teachers growing up, right? I have a weird brain where I have an ability to simplify to complicate it. So when I take notes or I explain stuff, I try to do it in the most simplest way. That's just how it helps me learn. And all growing up, my teachers would make fun of me and being like, you can't do that, you can't do that, you're never going to get good grades doing that, blah, 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 blah. And despite going through a period of not getting the greatest of grades, it has now become one of the reasons that our educational platform was featured in Forbes magazine, why it is one of the most popular platforms out there, and one of the only platforms that has lasted, man, what are we going on? We've been teaching for a decade and a half now. It's because specifically Jason and myself, we're kind of blue collar individuals. We have the ability to take what everyone tries to make complicated and fancy and dumb it down into the simplest of forms. That way everyone can understand and hopefully everyone can have a possibility. So take that, unnamed teacher. I know your name. I'm just not going to say it to you because you might be listening and I don't want to make you feel bad because I'm a nice person. So anyway, what is margin for dummies, right? Margin, trading with margin is essentially trading with a loan, right? So when you're trading, you can do this with stocks now. When you're trading a stocks, when you're trading a currency, right? It takes a massive amount of money to have access to that. Typically, especially in the currency market, no one has enough money to really buy anything of value. So what you're doing is you're going through a broker and the broker is pretty much giving you a loan. You're saying, hey, broker, I want to buy this much of this thing. The broker's like, it costs this much. And pretty much they're saying, but if you give me $50, I will front the rest of it and allow you to buy the thing or sell the thing that you didn't have enough money to buy beforehand, right? Pretty much like a loan. So what is margin call? Well, margin call is pretty much when your loan gets called out for default in a sense, right? So one of the, I guess, the biggest misconceptions in trading is that you can actually go broke. You can't actually go broke. Well, you can if there's like a weird black swan event, like the Swiss pulling the rug underneath. But aside from those weird events, you can't really go broke. Why? Well, because before you go broke, you will hit something called margin call, right? And margin call is basically when you have used up the available leverage that you have and your broker shuts you down. So let's imagine that you are a trader and you're risking a lot and you don't have a stop loss on, and that trade keeps getting lower and lower and lower and lower. Your losses keep getting higher and higher and higher and higher. You won't actually hit zero in your account. What happens is once you hit a specific amount of your account, and for most brokers there it's either 25% or 50%, whatever like that, they will shut you down. They will say you have hit margin. You either have to put more money into your account, or in most cases they will just automatically take you out of the trade and shut you down. I actually have a very funny story. It wasn't funny at all at the time, but in hindsight it's very funny. Most of my stories in the past are very like depressing and they make me nauseous thinking about, but at least I've moved past them now. But here is how I discovered margin call. So a really long time ago, when I was a young, reckless trader, this is before I knew anything about trading. I had just come from the stock market, had super massive success. I was going to conquer the Forex market and make it mine. And I had no idea what I was doing. I had no idea about technical analysis. I had no idea about the nature of how Forex moved. I just got in and started trading stuff. So I was trading stuff and buying this and buying that. I'd have like a million trades on at the same time. I didn't have any clue about risk management per trade. I didn't have any stop losses on, right? All this, every rookie trader mistake you could think I was making. And I was trading while working 3 jobs at the same time. So I'd wake up in the morning, place some trades, and I would go to my job and I would like check it on my cell phone. There weren't like any apps connected to my broker. This is, again, way back in the day. But I would go on like financial sites and be like, oh, the euro dollar is at this price, or the dollar Swiss is at that price. And it gave me an idea of like if I was up, if I was down, whatever like that. So I would enter the day, I'd have all these trades, like a million, not a million trades, but I may have like 4, 5, 6, 7, 8, 9, 10 trades on at the same time with who knows how much risk. And I remember there was one day where I'm tracking them, and like these trades are going bad. So of course, like whenever trades are going bad, what do? You hang up your device and like don't worry about it. Out of sight, out of mind. I just don't want to think about it. I get home, right? And to my surprise, something must have happened during the afternoon, right? Probably like an FOMC meeting or something like that. All the positions that I had on were up. Right? I'm checking my thing on the way home. I'm like, oh my gosh, you're up. I'm going to make all this money. I can't wait to go home and check my chart, man. Because like all 6 of these, 70s, 80s, 90s, 10 trades, right? Made a bunch of money. And I got home and I see the candles, boom, skyrocket. I'm doing the money dance. Oh yeah, oh yeah, oh yeah, oh yeah. And then like I go to one of my screens, my main screen, and I see like a little pop-up. And that pop-up says, you have hit margin call. And I'm like, okay, man, I guess when you make as much money as I do, they reward you with something. Margin call. Like, did I win an award? I had no idea what it was. I thought I won an award for being so good. Like I'm the top margin of trader or something like that. So I hit up the Googler. Dear Google, what is margin call, right? And I read about it and I'm like, oh no, what the hell? And I go back, I actually look at my broker statement and all that fun stuff, and I realized like, before every trade went in my direction, it had went down long enough or far enough that I used up my available margin. I was taken out, exited out of all my trades by my broker, and I lost a whole bunch of money and missed an opportunity to win a bunch of money. And that's how I learned what margin call is. So for you guys listening to this podcast, if this is your first time hearing about it, your way of hearing about it is much better than my way of hearing about it, because that was not fun. But that is margin call. So let's go back to the question. And the original podcast, if I remember correctly, we were talking about portfolioization and building a portfolio and managing risk. And the difference between, I guess, trading on a higher time frame and a lower time frame. And the biggest difference is this, is usually frequency of trading, right? So on higher time frames, there is a higher time duration, right? The daily chart has 1 candle per day. The hourly chart has 24 candles per day, right? There is more candles on the hourly chart than the daily chart. Therefore, there is more frequency on the lower time frame than the higher time frame. Therefore, there are more trading opportunities on the lower time frame than the higher time frame, right? If you were to take 2 traders and one traded the daily for a month and one traded the 15-minute for a month, the 15-minute trader is going to have a lot more trading opportunities than the daily trader. So I'll give you another example, right? At this point in my career, I probably take about 15 trades per month. Yeah, I know that's mind-blowing for many of you guys. Like only 15 trades per month. I am a swing trader, 4-hour hourly is how I get down. However, back when I was a day trader as well, and I day traded and swing traded, but if I just think about the day trading, if we think about the day trading, I probably took about 15 trades, so the same amount as my swing trading takes in a month. I probably took those 15 trades in about 2.5 weeks, maybe, so almost double the amount of frequency just because of how many signals occurred. So what that means is this: I had to deal with having a lot more potential exposure. And again, part of risk management is understanding what is kind of my, not just your max allowable drawdown, meaning like how much can you lose before you got to shut things off before you get that margin call, but what is my maximum exposure and am I comfortable with that, right? So as a swing trader, because I'm taking 15 trades a month, right, it's very rare that I'm ever in more than, I would say, 3 trades at once. I can't remember the last time I was in 3 trades at once. And typically if I am in 3 trades, one of them is some type of long-term trade, which the reason it's long-term is because it's going in my direction. And I've probably rolled stops to break even or in profits. I don't have to worry about any type of loss there, but probably no more than 3 trades at once. So if I'm setting up my risk, I can prepare to handle a maximum of 3 trades. So let's say, and I would never do this, but let's say my maximum allowable risk at any given time is 8%, right? Or 9%, let's say 9%. Theoretically, I can be in all 3 trades with 3% risk and be within my maximum allowable risk, right? Now, let's go down to the lower time frame trader, the 15-minute chart trader. If they're getting 15 trades in about 2 weeks or so, right, there is a good opportunity that you can be in 4, 5, 6 trades at the same time. And I remember as I was a day trader, there would be times where I would be involved in 5, 6 trades, right? In my particular trading style, my trades tend to come in bunches and then just do nothing for weeks. But if I take that same 3% risk, oh my gosh, I gotta do math now, and I multiply that by the 6 trades that I'm in, all of a sudden I've got an 18% max risk on the table, meaning that I can lose 18% of my account balance at any given time because that's how much exposure I have to the market. And, you know, although 3%, that's still enough where I'm not going to get margin call. If you can imagine traders out there that are risking 5%, all of a sudden 5 times 6, that's 30. You may have hit that margin call or you're one weird move away from being at that margin call level. So what this trader was asking was that because my frequency is so low, I think he said 2 to 3 trades per week, right? Which I would assume that, I guess technically you can have 3 on at the same time, but if you're doing 2 to 3 trades a week, you're probably not going to be in 3 trades at the same time. Can he risk more per trade instead of that 0.25 or 50%, or not 50% risk? No, don't do 50% risk. No, half of a percent risk. Can he afford to risk a little bit more? Maybe 1%, maybe I think he said 2%. I'm not sure if he said that or not. Yeah, maybe 1%. And the answer is yes, because, and risk is going to be, risk is going to be different per person and whatever your comfort level is. But I can tell you that most traders in general, 3% is kind of that limit where if you get above 3%, that's super risky for your professional trader. Most are between 1 and 3. But if this trader, say, did want to go to a 3% risk a lot, maybe it's a high win percentage type of strategy with low drawdowns, then yeah, they can certainly afford to risk more because you have your 3% risk. If you're in 2 trades at the same time, you have 6% risk. You're probably not going to be in 3 trades at the same time, but even if you were, that would give you a max of 9% risk. And as long as that's within your comfort zone of being able to stomach that, then you're okay. Obviously, you got to take a look at the bigger numbers as well, maximum drawdown, biggest losing streak, all that fun stuff to make sure the numbers work in the bigger picture. But in theory, yes, you can afford to risk more when your frequency is less because you don't have as much total exposure versus risking less when you have more frequency, because you're going to have a higher amount of trades on, or you have the potential to have a higher amount of trades on at the same time. So I hope you guys enjoyed the show. Remember, May 29th, online trading workshop. Sign up now before the event is booked. Also, head over to the YouTube channel if you're not there already. Check out the short section. They've been on fire lately. A lot of good responses for those little short, quick trading tips that I put out on a daily basis. Run through them, get your daily fix, and make sure you subscribe if you're not already. All right, until next time, plan your trade, trade your plan. See ya.